Everything is going wrong for your money right now. And I do not mean one thing. I mean almost everything simultaneously. Stocks are down 7% year-to-date on the S&P 500. The Nasdaq has fallen over 10%, putting it in correction territory. Bonds, which are supposed to be the safe haven, also fell. Gold, which rose dramatically earlier in the year, has now pulled back more than 10% since the war began. And Bitcoin dropped alongside everything else in what analysts are calling fear liquidation. Investors sell everything regardless of quality just to raise cash. Moody's recession model now puts the odds of a U.S. recession at 49%, 1 point from the threshold that has predicted every single recession in 80 years of backtested data. A new BlackRock survey just revealed that 30% of Americans have absolutely zero retirement savings. Not a little, zero. If you feel like everything is simultaneously going wrong with money right now, you are not imagining it. You are just paying attention. And the fact that you are watching this video means you are already ahead of the people who are not. In the next 13 minutes, I am going to show you exactly what is happening and why. Who is winning in this environment despite everything going wrong? And the complete 7-move survival plan to protect your money and position yourself for what comes next. Stay until move 7. I saved the most important one for last. Let me explain what is actually happening because the mainstream financial media is not doing a good job of connecting the dots. There are 4 separate crises happening simultaneously and they are feeding each other. Crisis 1, the oil shock. The situation in the Middle East pushed oil from $67 to over $100 a barrel in under 2 weeks. Oil is not just fuel. It is the foundational input cost for almost every good in the economy. When oil spikes, everything gets more expensive: food, shipping, manufacturing, heating. And the full inflationary impact of this spike has not even reached store shelves yet. That comes in the next 3 to 6 months. Crisis 2, the tariff squeeze. The average U.S. tariff rate jumped from 2% to over 12%. Analysis estimates this costs the average American household $600 per year through higher prices on imported goods. 2/3 of that cost gets passed to consumers. You are paying it right now through slightly higher prices on almost everything you buy. Crisis 3, market valuation correction. The stock market entered 2026 significantly overvalued by historical standards. The S&P 500 P/E ratio was above 22 against a historical average of 18.8. When overvalued markets meet real economic headwinds, they correct. That correction is happening right now and it is being amplified by the oil shock and tariff fears, creating a loop of declining confidence. Crisis 4, the retirement savings gap, with 30% of Americans having zero retirement savings. And the market declining, the people who do have savings are watching their portfolios shrink, while the people who do not have savings are running out of time to build them in a volatile environment. 4 crises, all hitting simultaneously, feeding each other. This is not normal market volatility. This is a convergence of multiple independent pressures at the same moment. Here is the part of this story that most financial commentators are not talking about enough. The fear itself is becoming a problem independent of the underlying economics. Moody's recession model is at 49%. But the underlying economic data is not as bad as that number suggests. GDP growth is still projected at 2.4%. Corporate earnings are still positive. Unemployment at 4.4% is elevated but not recessionary. So why is the recession model so high? Because it is reading consumer and investor sentiment alongside economic data. And right now sentiment is deeply negative. Fear is spreading faster than the actual economic damage. Economists call this a self-fulfilling prophecy. When enough people believe a recession is coming, they start acting like it is already here. They cut spending. Businesses freeze hiring. Investment slows. And the economy actually contracts. Not because of the underlying fundamentals, but because the fear of contraction caused the contraction. This is the most dangerous part of where we are right now. Not the oil shock. Not the tariffs. The fear spiral that these things have triggered. And this is also why the current moment is both dangerous and filled with opportunity. Because fear misprices assets. When fear drives prices below their fundamental value, the gap between price and value becomes profit waiting to be captured. by anyone calm enough to see it. While most people are panicking, there is a group of people doing extremely well in this environment. Understanding what they are doing differently is the most valuable thing I can tell you in this video. The people winning right now share 3 characteristics. First, they are not checking their portfolios daily. Research consistently shows that investors who check their portfolios more frequently make worse decisions. The constant visibility of losses triggers emotional responses that override rational decision-making. The best investors set their allocation, automate their contributions, and look at their portfolio quarterly at most. Second, they are buying during fear. The most counterintuitive truth in investing is that the best time to buy is when you least want to. When the market is down 7%, every dollar you invest is buying 7% more assets than it would have bought at the start of the year. That discount is real, and the recovery will capture it for you over time. Third, they have multiple income streams. People with a salary plus investment income plus a side business are not dependent on the stock market or the job market for their entire financial security. When one income source is threatened, the others continue. This redundancy is what separates financially resilient people from financially fragile ones during downturns. Here is the plan. 7 specific moves ranked by urgency. Do not try to do all 7 at once. Pick the one that applies most to your situation and start there today. Move 1. Do not sell anything in your long-term investment portfolio. I am putting this first because it is the most urgent and the most commonly violated. Selling during a downturn locks in losses permanently. The market has recovered from every single downturn in its history. Everyone. The only people who did not recover were the people who sold during the fear and missed the rebound. Do not be that person. Move 2. Open a high-yield savings account today if you do not have one. The best money market accounts are still paying around 4% AP. Your standard bank account is paying 0.5% or less. Move your emergency fund there immediately. This takes 10 minutes, requires 0 risk, and generates significantly more interest on money that should be sitting in cash anyway. Move 3. Build or protect your 6-month emergency fund. This is your most important financial buffer during economic uncertainty. If you have 6 months of expenses in cash, a job loss becomes an inconvenience rather than a crisis. If you have 3 months, a prolonged job search becomes a financial emergency. In a softening job market with layoffs accelerating to 6 months is the minimum you should be targeting. Move 4. If you have investable cash, consider deploying it into index funds systematically. Not all at once. Spread it across 3 to 6 months of consistent purchases. This dollar-cost averaging approach means you buy more shares when prices are lower, and fewer when they are higher, automatically giving you a lower average cost per share over time. In a volatile market, this approach has historically outperformed lumps, some investing by a meaningful margin. Move 5. Check your asset allocation against your age and timeline. A general rule: subtract your age from 110 to get your approximate stock allocation percentage. At 30 years old to 80% stocks, 20% bonds and cash. At 50 years old to 60% stocks, 40% bonds and cash. At 65 years old to 45% stocks, 55% bonds and cash. If you are significantly outside these ranges in either direction, now is a good time to rebalance. Move 6. Add defensive positions to your portfolio. During economic downturns, certain sectors hold value significantly better than the broader market. Utilities: people pay their electricity bills regardless of economic conditions. Consumer staples: people buy food and household products even in recessions. Healthcare: people see doctors regardless of market conditions. ETFs tracking these sectors minus XLU for utilities, XLP for consumer staples, XLV for healthcare, have historically outperformed. During recessionary periods, consider shifting 10 to 15% of your stock allocation toward these defensive sectors. Move 7. Start one income stream outside your salary this month. I put this last because it is the hardest to start, but it is the most transformative over time. A single salary is a single point of failure. One layoff decision and your entire income disappears. But a person with a salary plus even a small side income has a buffer between themselves and financial disaster. Start with something you can do with the skills you already have. Freelance a skill from your day job. Start a content channel. Consult for 2 hours per week. Sell something. The dollar amount does not matter at the beginning. What matters is that it exists. Because once it exists, it can grow. And the income diversification it represents is worth more than any salary increase you will ever receive. Let me leave you with the most important truth about every financial crisis in history. The stock market crashed in 1929. It recovered. The market crashed in 2000. It recovered. It crashed in 2008, the worst financial crisis since the Great Depression. It recovered. It crashed in 2020 in the fastest bear market in history. It recovered in 8 months. Every single crash in history has been followed by a recovery. Every single one. The only investors who did not recover were the ones who sold in fear and missed the rebound. We do not know what the market will do tomorrow or next month. Nobody does. But we know with absolute certainty based on 100 years of data what happens over the next 10 years. For anyone who stays invested and keeps contributing consistently, they win. Not maybe. Not probably. Historically, they win. The question is not whether to stay the course. The question is whether you have the emotional discipline to do it when everything feels like it is falling apart. You watched a 13-minute finance video today when you could have been doing something else. That tells me something about you. Now take one move from this list before you go to sleep tonight. Subscribe to The Silent Shift. We post daily finance moves that protect your money, the kind that used to live exclusively inside investment bank boardrooms. Now they are here, free, for you. The shift is quiet, but it is already happening.